Hi, it's Aoife Devitt, and welcome to today's Markets Happy Hour podcast. Happy New Year to all of our listeners and followers. It is January 1st, 2026, and we are delighted to kick off the new year with a discussion of what markets have told us in the last few days, as well as a look at what some of the commentators and strategists are saying for the year ahead. So let's kick off. I've called today's podcast The New Year's New Nihilism, as this was a popular theme over the last few days. There was an article in the Wall Street Journal, there was a post on X, it had over 20 million views. It described essentially the generation that had been essentially now giving up on attaining a traditional path to wealth and was turning instead to gambling and essentially giving up on their dreams and trying to really bet it all on a very outsized dream. So this was something that was a reflection of perhaps the decline of the accessibility of the housing market, a rise in the affordability crisis, and of course the incursion of AI, as well as the problem with social media and the constant comparisons. So this was a particularly deep and somewhat dark rabbit hole to be dragged into over the last few days, but it has, I think, been a perfect launch pad for what we are seeing as our philosophy for 2026, which is this going to be the year of enough? We had suggested this last week that the year of enough in 2026 would be the time when consumers finally push back against the encroachment of AI. They suggest that maybe AI in developments and improvements, enhancements in their life have reached a point that there has been satiation or essentially the saturation point, and they don't need necessarily more efficiencies in some of the more human elements of their lives. There'll also be a pushback on the rising price of everything, particularly electricity. And we will see that, we believe, through pushbacks and policy changes and headwinds against the development of data centers. So that's all continuing of our theme for 2026 around the year of enough. But kicking off this week, as usual, we will discuss inflation, interest rates, equity markets, geopolitics, and other asset classes. And as far as some of the sub themes that we'll discuss in these topics, we'll be looking at some of the trends over the holidays. I've already discussed the nihilism. We'll also talk about some of the rumors that circulated in the aftermath of a severe correction in silver in this defining year for metals, as well as some of the talk around AI and what lies ahead for equity markets, not only in the US, but around the world. We will discuss how volatility has now become a feature of markets and not a bug. We will look back, as many commentators have done, at the year that we've had, ask what we have maybe got wrong about tariffs and sanctions. And then moving to geopolitics, we'll see that there is a little bit of a frosty start to the year, even before the year has really kicked off. Looking at equity markets performance, so the headlines would suggest that there certainly have been a defiance of the Sell America warnings, and we reached the end of 2025 near record highs. This led to the conclusion that the tariff policies did not raise prices as much as feared. So essentially that the establishment economists and commentators had got their prognosis on the Trump tariff regime wrong. And the AI part, the arms race certainly had powered growth that was, and we've discussed this many times, the absolute engine of US equity markets in 2025, as were the shares of the largest tech companies. What we did see in the last few days of the week was stock markets be a little bit more fragile. We saw silver prices had slid, and the S&P futures had edged down at year end. I think this is a good time to analyze the conclusion that many are jumping to, that we got the prognosis on Trump's tariff policies wrong. I think this is based on the assumption that there is a cause and effect that is instant and traceable, and that the chain of causation is very direct when it comes to something like tariffs. We've also spoken a bit about the transmission effect when it comes to interest rates. And we have observed that in the past few years and months, the transmission effect seems to be broken or at least severely delayed. We saw that when it came to the historically high hiking of interest rates, that it took some time for that to be felt in the economy. And indeed, it did not slow the economy for some time, and it took a long time for it to slow the pace of inflation. So there was a suggestion that what is in the mechanism of the economy that is therefore acting as a brake on what would normally be a fairly effective cause and effect of monetary policy. In the case of interest rates, what acted as the brake was the fact that there were many mortgages that were already locked in. There were perhaps some companies that did not need to necessarily depend on financing. They had stronger balance sheets, stronger cash. They could put off borrowing. And there was also the private credit market that they could rely on, even though that also would have been related to interest rates. So there wasn't that same necessary effect on consumers. And also certain consumers didn't own property anyway, so they wouldn't have necessarily been affected by the ability to pay their mortgage if their mortgage was going to be adjustable. That was more a direct effect in the UK, where most mortgages were shorter term and not fixed for as long as they are in the US. So if we can then accept that the transmission effect of many traditional instruments of policy is not necessarily direct, why did we assume that the effect of tariffs will be direct? Why do we assume that it would immediately translate into higher prices and that it would essentially act as to choke off global trade? What we saw in the aftermath of tariffs was a lot of preempting of the effect of tariffs and essentially importing in advance of those tariffs taking effect. That was attributable to a massive surge in imports in the first quarter of 2025. We also saw inventories build at that time. And then there was a subsequently reduction in imports. And we saw that in the last GDP print for the US, which did distort the GDP number slightly because they had perhaps been all front loaded at the beginning of the year. So that may have been a reason why there hasn't been that instantaneous effect of tariffs. We also know that many companies were themselves absorbing the impact of tariffs. And that was something that indeed the president had endorsed and had expected companies such as Walmart to do. So we know that many small and mid-cap companies, even though they didn't have necessarily the balance sheet strength that some of the larger companies would have, did still have the ability to absorb tariffs. And they did not pass it through to consumers, the consumers that were already flinching from particularly high inflation. So all of these factors could act as a brake on the transmission effect of tariffs. It's also worth remembering that many tariffs were on again, off again, and we did have some reversals and U-turns over the course of 2025 when it came to tariffs. So we didn't necessarily have a plain sailing when it came to the application of tariffs or a uniform application across various trading partners. So the other thing to bear in mind is that many trading relationships get cast over longer periods of time. And we now know that China is forging strong relationships outside the US, and we won't see the effect of these relationships and some of the circumnavigation of global trade for some time. So I think the error may have been expecting the effect of tariffs to be instantaneous, as well as some of the rather more unorthodox geopolitical stances that the President Trump's administration took. Equally, we probably expected that to be more instantaneous, and we should not have. So I would say it is a little early in the day to necessarily conclude that the tariff policies haven't raised prices, nor will they have a detrimental effect on the US economy. I would suggest that tariffs are going to have a much more protracted effect, and that's something certainly to watch over the course of 2026. Moving on in terms of interest rates, well, we know what the Fed rate cut was in December, but now over the last week, we've seen the Fed minutes. We've seen the extent of the divide and how it was really quite a toss-up when it came to how this decision would fall by the Fed, which I think probably is more suggestive of more of a hawkish stance that we might have given them credit for. Certainly, this rate cut was well expected. We'd had a little bit of softness when it came to labor numbers. We did know that inflation was coming down. We knew that they could be secure in cutting rates in the sense that inflation was not likely to be fired up again. But I think what is notable is that there were many who were not inclined to cut rates at that time. And this may put a little bit of a spanner in the works when it comes to the notion that the next Fed chair will be essentially letting off the brake of monetary policy and releasing the monetary floodgates when it comes to interest rate cuts. It seems that many on the Fed board are quite concerned about the potential for a very hot economy melting up. And they certainly know that there are weaknesses afoot, and they would perhaps like to reserve their ability to cut rates for a time when they are actually needed, as opposed to at this time. And the other thing to bear in mind with rates coming down as they have is that this is likely to lead to an ongoing weaker dollar, which will have ramifications for Americans abroad a little bit later in the year. Of course, looking at the trends themselves, moving to equity markets, we know that there has been a roller coaster year. We've spoken about that before. I think it's even more pronounced when we see it in a chart form. And as we discussed last week, I think a story that has not received perhaps that much attention has been just how Asia has surpassed the US and Europe in a very strong year of stock gains. The feature we've commented on many times is that because of the concentration of equity markets today, particularly in the US, we do have volatility now rising essentially in equity markets, in individual stocks, and that this should be considered as a feature and not a bug. So we need to be able to embrace more volatility as we look at the equity allocation in a portfolio going forward. That will have to be a consideration when it comes to the sizing of that position, as well as the breadth of that position, whether the equity position is spread across multiple cap sizes or across a broad range of countries and geographic exposures. I did think it was somewhat amusing that given that we're speaking about volatility, it is good that we've just had the Vanda Pharmaceuticals motion sickness drug approved by the FDA, tradipitant, which is, if we are feeling the effects of volatility, at least we now know we have a drug to prevent that. Moving on to some of the other aspects, we mentioned the Asian markets and how well they have performed over 2025. Tech has, of course, been a strong underpinning of the rise in Asian markets. We've known that. We know that that has driven the China stock market for some time, as well as Hong Kong. And equally, I think it's an interesting statistic here. We've spoken a little bit about the demise of the IPO market in the US. We have seen some bright spots. Most of that has been tech-led. I think what's interesting to see this chart from Bloomberg, which pointed to Hong Kong IPOs, whereas Hong Kong is closing 2025 as a busy month of deals, seeing the highest level of IPOs there since 2019. So for 6 years, and the tech stocks dominate that when it comes to listing, particularly AI stocks in Hong Kong. So very much a parallel story emerging there in Asia as to what we're seeing in the US. And this could probably bode well as well for IPOs in the US, as we would expect that would likely be an essential piece of market health next year, as we know that so many private equity firms are reliant on that exit strategy. So that will be definitely a barometer of the market breadth as we move into 2026. Other shining lights out of the markets that we've spoken before about how traditional banks have been a surprising champion of 2025. And we've seen that all 6 major banks, the so-called too big to fail banks, outperformed the S&P over the course of 2025. JP Morgan, Bank of America, Wells Fargo, Goldman, Morgan Stanley, Citi, all outperformed the S&P 500. And we now know that the market cap of the 6 biggest banks has now pushed past 2 trillion in 2025. So again, getting quite too big to fail, we could say. And this is something to put a pin in as we think about the developments in the silver and metal market over the course of the last week. We will discuss a little bit later how margin requirements, increase in margin requirements led to margin calls, and that there was one particular bank that was unnamed, although rumors did circulate, that was particularly badly caught in a margin call on silver. And that did require a kind of a quiet behind the scenes bailout that has certainly not reached any headlines. There were 2 suggestions behind that. One was that the CME raising of margin calls was in response to certain big banks that had short positions on silver, and they wanted to essentially protect those banks from losses because their short positions were untenable as the silver price continued to rise. There was also, on the other side of that trade, there were some other large banks too big to fail that were seriously hurt with some of the increased margin requirements. So clearly, if these banks continue to rise in terms of their market cap and their importance, and there is a sense that they're all becoming too big to fail, just looking at this chart here on the bottom right, JP Morgan is now representing about 1/3 of the total market cap of the 6 largest US banks, and with the second, Bank of America, in basically close to size in terms of the next 4. But it's definitely one to watch. If these banks are too big to fail, what kind of policy will follow? Other strong performers as we look at this just out of the year, we've had some SanDisk and AI linked stocks again leading the index. Western Digital, SanDisk was up close to 600% for the year. Western Digital up 300%. I know SanDisk from the maker of those memory cards that used to go into my camera. So clearly storage and data storage has been a key theme. Warner Brothers, Palantir, also up well over 100% in each case, some with particular special situations, particularly in the case of Warner Brothers, but we can see that some really staggering outperformers, which if you had been an active stock picker and had been able to select those, that would have been a winning strategy for the year. But as we've discussed before, this has often not been the case for active stock pickers. Has been a much more challenging year than that. Looking across some surprising sectors that have done well, and I thought this was interesting. We've spoken a lot about the headwinds around clean energy and green energy that the Trump administration was likely to bring in and had brought in because of its dramatic U-turn and shift in policies from the Biden administration. What we have seen, though, is that whether it's concerted or essentially a collateral damage, we have seen a weaker oil price persisting for much of the Trump administration. So this has been good news for consumers in terms of the cost of gas at the pump. And it has certainly been a welcome relief on the inflation side. But it has, I would say, it's also keeping energy down. But what we can see is that such is the demand for energy that the Clean Energy Transition Index has been up over 40% year to date. So this is really a sign that there is an insatiable demand for energy from all sources. And we've spoken before about the fact that there has been this price of electricity forming a large part of inflation has been a reason why many consumers have pushed back against data centers, essentially hogging that electricity in their neighborhoods. John Authors from Bloomberg did a very interesting hindsight capital where he looked back at some of the trends and some of the positive and negative trends in markets. And when he would position the S&P clean energy relative to WTI crude, you can see that it outperformed by close to 80% over the course of the year. So very strong return in terms of a short crude and a long clean energy side. So this is a welcome respite for many of these stocks that did face, in many cases, direct headwinds from the Trump administration. I'd say that this underscores that the companies that were sustainable had strong business models that made sense from a fundamental standpoint, that they were likely to survive in the current wave of energy transitions. We've spoken last week about how 2025 was a defining year for metals. And our conversation in that case related to the rise of silver, the rise of gold, both touching record highs, and essentially the relentless rise of these metals, which really was unabated for the course of the year. If we look at the trend over the course of the top left chart, you can see that gold did not suffer the dip, although silver did at the time of the Liberation Day tariffs. It was a very steady rise and has been up essentially close to 60% year to date. And silver has had an even stronger performance of over 100% year to date, although it has had a very stark volatile development in the last few days. So this we've spoken about from really a sense of mixed drivers. We've spoken about how this could indicate a concern around currency debasement. It could also indicate a concern around the rising budget, current fiscal situation, budget deficits, and how that would be unsustainable. There were also technical factors at work. Central banks, through either stocking up in gold at the expense of the dollar or simply stocking up in gold as a way to fortify their reserves and not necessarily at the actual expense of the dollar. Although we have seen the dollar seen less demand and have had a weak year, its weakest year in about 7 years. But when we look at this, at the rise of gold, I think this is probably the one alarm bell that has been ringing for even the strategists that are relentlessly positive year to date. They are suggesting that there are forces at work which is seriously indicating lack of trust in government, lack of faith in fiscal policy, and lack of faith in some of the hard currencies, in particular the US dollar. So this is something we need to watch. Is this simply a technical trend? Is it a risk-on trend? Or is it, somebody had suggested it was fear versus greed, whereas the Bitcoin rally was driven by greed in the face of uncertainty. The gold and other precious metal rally was driven by fear in the face of uncertainty. So two very interesting behavioral trends at work there. But what we did see just over the course of yesterday was the silver price sliding after the CME had hiked its margins again. This was the second time that it had done so in a week. And that stark movement in silver is, again, an indication just perhaps how thinly traded it is. And just, again, when we do reach these heights, the kind of volatility, returning to the theme of volatility being a feature and not a bug. Moving outside the US into the sphere of geopolitics, we are again, given this is the time for 2026 forecasts and 2025 lookbacks, there has been a lot of focus on the Russia-Ukraine situation, particularly as it pertains to Europe. We know that European defense stocks have been a surprise winner of 2025, and that rearming essentially in Europe for the first time in decades is not simply a response to the new Trump administration's approach to NATO and to defense spending, but equally does seem to be a response to what is seen as I suppose, a desperation at the inability to resolve the Ukraine-Russia conflict, and a concern that if it is not resolved in Ukraine's favor, that one of the European nations will be next in line to be threatened by Russia. So real fear that there is instability afoot in Europe over the year ahead. We also have AI and the drumbeat of AI replacing jobs rising now up the spectrum in terms of attention by European media. A headline this week to see the AI forecast about 200,000 European banking jobs, primarily in bank and middle office at work. We know that London certainly is a large financial centre, and to see the AI encroaching upon not just banking jobs, but also other white collar jobs, this could be a serious threat to an economy that is already lacking in some of the drivers that the US economy has shown. Some interesting charts this week also around housing. And we think about housing not only as a support for the consumer, but because real estate is a solid diversifier in any portfolio. And indeed, residential real estate could be a component of a portfolio. So it is important to look at the resilience of housing, because not only does it drive consumer sentiment, but it can also drive income in a portfolio. And some interesting charts suggesting that there was actually maybe a silver lining to some of the building boom that we've seen. We've often been wringing hands about Gen Z not being able to purchase houses, and therefore taking the assets they would have put into houses, investing them in the stock market instead, and that actually having quite a positive outcome. This is again playing on a little bit of the nihilism that we've spoken about before. Some charts here that would paint a somewhat rosier picture than we have been painting recently about real estate, suggesting that wage increases have finally pushed ahead of house price gains. That has been very welcome, because house pricing did outstrip wage increases for some time. So to now have wage increases follow suit, that should at least push the affordability needle a little bit into Gen Z's favor. And it's also suggesting that because baby boomers are now receding as a force, they are downsizing, they're perhaps now selling on, there is a bit of a transition in that baby boomer wealth. They will be in the prime first home buying years as home ownership among baby boomers recedes. So pure technical factors there should be driving this. And there's also been some articles over the course of the week about how some of the building of high-end and perhaps less affordable apartments in big cities has created a gap and a rise of availability of the second tier apartments and other residential options, and that they are now becoming more affordable because they've been forced to drop prices. So this has been, again, a collateral benefit of some of the great developments. And then we can see that just in terms of housing milestones, we see that people, we've known this for some time, they are delaying buying homes. But they, again, if they are delaying buying homes, maybe being patient in this respect could well be a good thing for young people as they then are ready to buy a home as baby boomers are moving out. Quick look at other asset classes. We've seen that the Bitcoin has been faltering over the course of the end of 2026. And again, when we see silver relative to Bitcoin, much better proven as a store of value than cryptocurrency. Unclear, therefore, as to Bitcoin's actual purpose. We've heard a lot about Bitcoin treasury by companies, and this was, at one point, it was a way to leverage the Bitcoin frenzy, and suggesting that some of the treasury will be held in Bitcoin provided a boost to stocks. We've seen, I suppose, the sheen has come off that particular trend for some, and there was a headline this week to say that David Beckham's health firm that he's backed has ceased its Bitcoin treasury plans. So given the volatility in Bitcoin, the uncertainty about how it's likely to behave, it certainly would not be perhaps a reliable store of value for treasury functions at this time. And finally, to talk about the dollar, again, this is something that is continuing as we end the year. The drop in the dollar, its biggest annual drop since 2017. We are seeing also forecasts around interest rate cuts in the US only driving the dollar further still, and that this is likely to be a factor that is going to affect the US market as we look at 2026. This will be a good reason for US investors to diversify their holdings out of the dollar into non-US markets, continue that has been a core piece of our Moneta philosophy for many years, and is supported by the divergent return drivers. We mentioned clean energy before. Europe has a strong affinity for clean energy, and a strong component of its stock market is represented by not only old economy stocks, but also clean energy. So the weakness in the dollar, another strong theme for 2026. The new nihilism I mentioned is highlighted in this particular X feed around the prison of financial mediocrity. It is a little bit of a depressing read, I will admit, for the focus on the big new year, suggestion that the current generations have nothing to work for, have lack of meaning, and that this is driving the speculative markets. And we've seen a surge in sports gambling, and we know that we've seen a huge rise in the ability to essentially speculate on anything from any outcome, whether it's a sports outcome, a political outcome, or essentially any outcome in our politics and society today. So it is a little bit of a depressing read, and would suggest that it's essentially a convergence of many of these factors: AI replacement, as well as social media comparisons. We've heard a lot about isolation. We've heard a lot about the desperation of the Gen Z and its inability to get on the spectrum. I think what I've been most interested in has been the pushback to this particular doom loop that was addressed in this Twitter piece, which has seen at this point over 20 million views. I think it is interesting to think, well, where is it that we find meaning? And I think that this will be of increased importance in 2026 as we look to where we find meaning in life, and when we say that enough is enough. I love to cite my good friend Brian Portnoy with his concept of funded contentment, that is the goal when it comes to financial wealth and planning. And funded contentment, the concept of enough, and to be able to fund with enough, what makes you content. And I think that this is something that we will increasingly question when we see the relentless march of AI and tech spending in 2026. There will be a point when consumers, regulators, employers, and customers ask, is this enough? Have we seen enough? And do we need to continue to support this trend any further, particularly when we don't know from a social impact standpoint where this could potentially end? So I think a little bit of pushback from a moral and society standpoint to watch for when it comes to many of these trends in 26. And that is our kickoff for the start of the year. It's been wonderful to chart the backdrop to markets for over a year now. We started this in November 2024, and I love to focus on the same 5 topics every week to give some structure to this podcast. And I love to invite other guests onto this podcast to share their views. And we'll see a little bit more of that in 2026. We'll see an ongoing cadence of live events when we love to get people together into the audience to speak and share their views from the ground on these different topics. And look forward to seeing you over 2026. And again, Happy New Year, everyone.